Thank you, John. Good morning, ladies and gentlemen. It is a real pleasure to be here with you, and to welcome all of you on behalf of EBRD, Euromoney, and the European Covered Bond Council. This is the first ever Covered Bond Conference focusing on EBRD countries of operation. I will use that phrase a few times, and that refers to the countries where EBRD is targeted to invest, allowed to invest. It includes Central Europe, Central Asia, Eastern Europe, etc. Now it includes Turkey, North Africa, but the focus for today's conversation will be on Central and Eastern Europe. It may have taken 25 years for us to get around to talk about covered bonds in Central and Eastern Europe. That is the 25 years that EBRD has been in existence. This is our 25th anniversary year. But it is finally the year when we see a number of positive covered bond developments in the EBRD region, and that is why we are all here today, hopefully at the beginning of a new era for covered bonds into this region. I'll talk in a moment about why this matters and what EBRD is doing to facilitate and cement this progress, but let me start with a few words on EBRD itself. To recall, the EBRD was created after the fall of the Berlin Wall, and its charter was written at the very beginning of the 1990s. As such, it was designed in an unusual period. It was designed at the height of market triumphalism and market domination. This thinking is also embedded to a certain extent in the charter of the EBRD. The EBRD was specifically created to be unlike other multilateral or regional development banks. It was created with a mandate to support the transition to a market economy, to support the private sector, and to promote private entrepreneurial activity. Of course, this was at the time when prominent political theorists like Francis Fukuyama spoke of the end of history, quote unquote. But for the countries emerging from the Soviet influence, the need for sustained international support in the form of finance for investment, as well as policy dialogue and capacity building, was actually expected to be fairly modest and fairly short-lived, given the strong political commitment to reform and reintegration with the rest of Europe for many of these countries. The invisible hand of the market, along with a small state, was expected to take care of the rest. However, the transition process was not as short or as smooth as those then expected. 25 years later, we are still transitioning, and the prospects are for many more years of transition to come. But EBRD in this context is very strongly supporting that process through a multitude of ways, but particularly through several thematic private sector initiatives, and one of those is what I want to speak about today. Currently, EBRD runs 3 private sector-oriented strategic initiatives. One is on sustainable resources, where we are the largest investor in energy efficiency, renewable energy, sustainable energy of any of the IFIs. The second one is small business, but the third is the development of local capital markets. Let us today focus on that third one, strengthening local capital markets and encouraging the use of local currencies is one of the EBRD's priorities across its 36 countries of operations, both through investments, and investments I mean in market infrastructure, investments in new products, investments in market expansion, as well as through reform of legal, regulatory frameworks, reform of market practice as well. One of the capital market instruments important under the EBRD Capital Markets Initiative is indeed covered bonds. Over the past decade, covered bonds have become an important source of long-term funding, particularly for our banks. Due to their structural features and long history of no defaults, they have proven to be crisis-resilient instruments over and over again. From an investor's perspective, they are an attractive investment alternative to government bonds, guaranteeing a similar level of safety, but with a slightly higher return in most cases. Advantages of covered bonds are reflected in their regulatory treatment under the Capital Requirements Directive and under Solvency II. However, before 2008, covered bonds were not a hot discussion topic in the city like they are now. This was mostly due to their simplicity, which now has become their strength. John spoke a little bit about the history of covered bonds, but I remember my days somewhat fondly in the early part of this century when covered bonds were boring. They didn't have enough pizzazz, enough excitement to make it worthwhile for capital markets people to care. They didn't have enough interest for investors because investors thought they knew how to analyze bank credit. And in the emerging days of the credit market in Europe, they all wanted yield. So nobody was driving for it, not investors, not issuers, and certainly not capital markets people. But that is different now. Following the 2008 financial crisis, the strategic importance of covered bonds as a long-term funding tool has been recognized globally. Covered bonds are playing an important role in the developed capital markets, contributing to the efficient allocation of capital and ultimately to economic development and recovery. These benefits and developments could not go unnoticed by the authorities of EBRD's countries of operation. Recognizing the potential value of covered bonds for the local banking sector, so often reliant on parent funding from Western Europe, and the development of local capital markets, many EBRD countries started talking covered bonds. The challenge has been to turn that talk into doing. Now they have either introduced or are working on introducing covered bond legislation in many of our countries. At this stage, new covered bond laws have been adopted in Poland, Turkey, Romania, while countries such as Croatia are in the process of introducing the relevant legislation. All of these with EBRD support. Why do we care? EBRD strongly supports covered bond reforms and investment as they can provide several key benefits to a transition economy. They allow banks to fund longer-term assets in a way which is cost-effective, but also more accurately matched to the terms of those assets and relatively delinked from their own credit rating, which allows market access at times of market stress. This very much contributes to the stability of the banking system. This is particularly the case in the EBRD region, where so many of our banks so often rely on funding from a parent, either an Italian or a German or an Austrian bank, for example. The Vienna II initiative advocates for such reliance to be decreased and local funding sources explored, and that's what we support as well. Use of covered bonds as a funding tool also encourages banks to responsibly underwrite mortgage loans in their market, as they are secured on a portfolio of high-quality mortgage assets subject to strict quality controls. As they provide term funding for banks against high-quality mortgage assets, they therefore incentivize prudent origination of home loans at home. Now, how do we at EBRD support covered bonds? We do it through a variety of available tools, all of the tools, in fact, of the Development Institution Toolbox. First, policy dialogue. Second, technical cooperation. And third, investments in the actual securities themselves. Do we already have successes in this regard? Absolutely. Let me discuss a few countries, country by country. First, Poland. The Ministry of Finance and the EBRD worked together to create a new legal and regulatory framework for covered bonds. Such work resulted in a new covered bond legislation. The changes came into effect on January 1, 2016, and are likely to lead to a significant increase in issuance of Polish covered bonds. The amendments are also the first in Europe, providing for a pass-through structure. We are very pleased to have recently invested roughly 5% in the covered bonds issued by PKO-BH. That was a 500 million zloty issue. It is the first large issuance in Poland under the new covered bond legislation that EBRD advised on. We were prepared to invest more than that 5%, but the success of this offering, more than 2 times oversubscribed, made it unnecessary for us to do that. A very good sign of investor sentiment and something we want to build on for sure. This investment demonstrates our commitment to the development of that market in Poland. Secondly, Romania. We worked with the authorities on the new covered bond legislative framework that was adopted in September 2015. The new law conforms to the definition of covered bonds as per EU legislation and the best practice supervisory guidelines as published by the European Banking Authority. But in Romania, as in many of our countries, covered bond legislation is only one piece of the puzzle. There are other parts of the puzzle that still need to be put in place, and we are still working on it, and I know many people in this room are also working on it. Third, Croatia. Covered bonds are currently not specifically regulated in Croatia, which creates a hurdle for potential issuers since elements typically expected, such as segregation, transfer of cover pool assets, or insolvency ring fencing, are not supported currently. That is why we have partnered up with the Croatian Ministry of Finance and the National Bank and are working together on this reform. Fourth, Turkey. We are actively engaged in Turkey, and by the way, I'm being a little bit expansive by putting Turkey into Central and Eastern Europe, but at EBRD we're very creative. So, Turkey. We have actively engaged in Turkey, where we have just invested 50 million euro in a 500 million euro covered bond benchmark issuance by Vakif Bank, the first covered bond issue coming out of Turkey. Hungary and Slovakia also progress, all through reforms and soon-to-be investments, we think. To date, we have invested in the two deals spoken about above, Turkey and Poland. But as of now, these are the only ones to have come to the market from the CEE region this year. We hope to invest in many more in 2016 and years to come. We are very proud of the recent covered bond developments in our region and are confident that with appropriate covered bond legislation in place, CEE markets will become attractive investment opportunities for international investors. We at EBRD, as an investor, are very keen to support new issues going forward, and we already have in place approvals at our board level to, in fact, invest across this region in many of these countries. You are all here for the same reason I am. Covered bonds are becoming more and more popular in the EBRD region, and this has been reflected in the increased legislative and investment activity in CEE. Recent developments, coupled with beneficial market conditions for the development of covered bonds, indeed indicate a very high potential for the CEE covered bond market. I wish all of you the best of luck for the conference, and I look forward to seeing many more covered bond issuers, investors, and issuances in the CEE market very soon. By the way, today is the first day of the EBRD annual general meeting. It's a 3-day event. It's a shindig, a jamboree. We get all of our owners, our shareholders from the 65 countries that own, but all from the 36 countries where we invest. So I personally will be meeting with ministers of finance of Croatia, of Turkey, of Poland, of Slovakia, all the people that many of you would be interested in knowing what they're thinking about from a covered bond point of view. And I will have the pleasure of telling them that I've just spoken at a conference. There's a lot of interest, a lot of focus, and people want to move this market forward. And we will be relying on them for policy support in this market. So I hope that there is a synergy between how they think and how you think, and we will find a way forward in a much more constructive, positive, momentous way. So thank you very much. It's nice to speak to you all, and good luck today.